Hello and welcome back to Accounting Information Systems. I am your host, Dr. B, and today we're going to talk about risk and risk assessment. Understanding risk is one of the important things in business because we need to be able to protect the company from inside risk, outside risk, and all other types of risk that may be involved in the business. It is incredibly important to understand the likelihood of something unfavorable occurring in the business. That is what we call risk. Risk is different by business type, size, industry, and location. Of course, if you're in a business that is of high risk, there is a high likelihood of something unfavorable happening to your business. If a company wants to, of course, be at the forefront of the industry, you must be willing to take some kind of risk. If you're developing a brand new product that has never been tested or introduced into the market before, you are a risk taker. The reason for that is because, of course, if that product does not work or is not received well, that is a risk. That is, of course, adverse and unfavorable to the company. It's important to understand what is acceptable risk to the business. We, of course, must take some risk, but how much risk are we willing and able to take? And looking at this bell curve, we can understand our risk levels. If you take a little bit of risk, you'll get a little bit of return. If you take a good amount of risk, your return might be much higher. However, if you take too much risk, your returns will probably diminish. Applying risk to the business, of course, involves understanding the company's ability to handle such risk. At what levels is risk acceptable? In looking at our example of the cookie shop, we understand that risk is inherent in the business. So here we have three types of business processes: the acquisition of raw materials such as sugar, yeast, flour, etc. We take those raw materials, we convert those through work in process. We add in direct labor, we add in factory overhead. And then when work in process is complete, we transfer that into finished goods available for sale. And then we sell those to the customer, which becomes cost of goods sold. Those are the three process types within our business. Understanding those three process types looks into a couple of different factors. For example, when we purchase our raw materials, we look at things like the supply chain, vendor management, purchases, payroll, etc. We look at the purchase of our raw materials, receiving our raw materials, and other activities like onboarding new employees. But what is the risk with all of those parts of purchases and payments? We have run a risk of duplicating payments to our vendors, unauthorized access to employee data, payroll fraud, etc. Remember, anytime that there's a human element involved, there is a risk associated with that. For conversion, we're converting our raw materials into work in process and then ultimately into finished goods. We're talking about raw cookie dough here. Okay. What's the risk? What if something happens to it? We get people sick. Okay. What if we have too much inventory? Unauthorized access. What if something happens to our inventory, falls off the back of the truck? winds up in one of your employees' trunks of their vehicle. Risk. Yeah. Now, what about when we sell our finished goods? What's the risk involved here? How do we do it? Well, it's face-to-face sales, online sales, sales through the mobile app with delivery. Risk is customer ain't going to be happy with the finished good. There might be a breach of data, of the customer data. And of course, there could also be revenue fraud, where the income statement's overstated through sales that weren't actually made. There's risk at every process, every step of the game. Look at risk in a couple of different ways. Look at our ability to optimize risk, where the business is making some risky moves. However, those risks are being mitigated through various strategies. We look at the overall portfolio and the profile of the company to understand the risk that we have the ability to take. We can manage risk. We can understand, analyze, prioritize, and respond to risk through what we call our enterprise risk management system. The enterprise risk management system, also known as ERM, involves a couple of different stages. The first, of course, is to identify our risk and the outcomes. We categorize that risk based off of its level of riskiness, based off of the specific business process related to that risk. The third step, of course, is risk prioritization. If there's a high risk involved, that receives a high priority. And of course, we respond to that risk based off of the possible risk outcomes. So identifying risk. We talk about worst case scenario. There are a number of different ways to identify risk. We do things like conducting brainstorming exercises, looking at data and previous events to understand what might happen in the future. We look at the diagram of the business, look for any weaknesses. And of course, we develop assumptions about operations and risk. It's important to have a risk statement in business. We look at the issue and any possible outcome. Risk statement. We categorize risk. Is the risk internal to the business? Is it an external risk? An internal risk involves employees. It involves customers. It involves vendors. It involves suppliers, etc. External risks, environmental factors. Environmental risks include things like downturn in the economy, natural disaster, other factors outside of the company. Internal risks, as I mentioned, involved employees, customers, etc. It's operation. We also have financial risk, over leveraging. Thinking about something like the current ratio. The current ratio, current assets divided by current liabilities. Do we have enough to satisfy our current liabilities? If we don't, that's a huge financial risk. Reputational risk, customer satisfaction, reputational risk. Here's an example of that. Here we have a customer ordered some cookies 2.5 hours ago. Cookies never arrived. It's reputational risk. This customer gave us a poor review on X, and it was multiplied 26 times. So yeah, that's reputational risk. External risks include things like compliance risk. Oh, Financial Accounting Standards Board comes out with some new recommendations and guidance. Sometimes there's a risk of not complying. Strategic risk, making the wrong moves in business. So I, produce too many of one cookie and not enough of the other. Physical risk, something could happen in the building. And thinking about strategic risk, we look at Blockbuster. Started in 1985 with video stores, made their way up to $8.4 billion in valuation in 1994. 1997, Netflix comes around. In 2000, Blockbuster refused to buy Netflix, and Netflix ended up crushing them down the road. Yeah, that's strategic risk. Absolutely. So you really want to look at and understand your internal risks versus your external risks. Really think about those two differences. Yeah. Oh, risk inventory, one of my favorite ones. In business, when you're dealing with inventory, you run a risk of shrinkage, which is the loss of inventory, whether it be through theft, damage, or some other loss. So that's why it's so important to make sure that you have proper internal control systems. You have to prioritize the risk. The riskier something is, the more quickly you need to deal with it. Yeah. Evaluating risk severity, it's kind of like color coding things. Yeah. Green is low risk, red is high risk. We do this based off of the likelihood of something happening, in other words, probability, and the impact. What would be the damage if that risk occurs? So likelihood and impact. We do this on a scale of low to high. Low risk is, of course, in green. High risk is in red. And then you have your in-betweens. You have low, medium, high. And between that, you get the medium high and medium low. It's kind of like a scale of 1 to 5. 5 being the most risky, 1 being the lowest risk. So, in thinking about that 1 to 5 scale, we can calculate what's called risk formulas. A risk formula involves that 1 to 5 Likert scale and is computed by taking the risk factor, the likeliness, multiplying that by the two numbers together. So here we have a likelihood risk scale. You'll notice 1 to 5 on the likelihood score. And then, of course, we have the annual occurrence percentage. What's the actual likelihood of something like that happening? So yeah, it's interesting. We can further extrapolate that on the 1 to 5 scale to what is the overall financial impact, how many customers are impacted, and what is the overall reputational impact. Yeah. From that information, we can develop what's called risk scores. They're treated differently based off of decision making. This would include things like the complexities of the products, averages, etc. Each company approaches risk differently and has their own calculations for risk. So there's no one universal strategy for calculating risk. The company develops a framework for it and applies that in a statistical, quantitative way. So those risk matrices help us to understand the correlation between the impact of risk and the likelihood of risk. We also categorize these as being what we call heat maps, green being low risk and red being high risk, with some yellows and oranges in between. We can visualize risk from a heat map perspective. So let me show you what this looks like. So here we have the risk matrix from a very visual perspective, low being green, red being high, and the correlations between the impact and likelihood. And then from a heat map perspective, very similar in nature, here we have the various events that have occurred or might occur, A, B, C, D, E, F, being represented here. So how do we respond to risk? We create what's called a risk management strategy. And this strategy involves the decision makers to understand each event and how to respond to each event accordingly. The company must take on some risk, but it's important to understand how much risk the company should be taking on. We call that a risk appetite. And four of the traditional risk responses are to accept the risk, to mitigate the risk through certain strategies, to transfer the risk to a different department or to a different company or to something else, or to avoid risk altogether. It's so important that we assess risk based off of its inherentness or residuals. Inherent risk means that there is no way to avoid that risk from happening. It is something that is ingrained in the possibility. For example, in our cookie business, we have an inherent risk of a customer getting sick from consuming undercooked product. Yeah. The residual risk from that, something like that, of course, is other customers realizing what had happened and then not returning to the business. So here's an example of inherent risk. Here we have event number 12 falling toward the top. So something like this can be relatively risky. So the residual of that is, the likelihood of something like that happening again moves closer to that inherent risk. In most cases, businesses choose to accept the risk when it is inherent, but the organization can, of course, work to mitigate that. The business could also avoid the risk altogether by avoiding things that would cause that inherent risk. And of course, oftentimes businesses try to mitigate risk whenever possible by minimizing the possibility of it happening in the first place through various strategies. And they could also, of course, transfer that risk onto a third party like an insurer. Okay, so that is our discussion on risk. And so looking back at your homework assignment for this week, questions 11 through 20 are involved in risk. And so you'll notice that those questions are very closely related to the presentation that we just went through. So I strongly encourage you to take your time, review the presentations, review the chapters, and make sure that you answer all of the quiz questions based off of what you learned about risk, questions 11 through 20. And of course, accounting information systems, questions 1 through 10. With it, if you have any comments, questions, or concerns, you need any type of help, please feel free to reach out to me. You can email me, call me, set up office hours, whatever you need. I am here for your success. Thank you so much for your time today. I appreciate you, and I wish you all the best. Thank you so much. Bye-bye.